Speaking of Victoria, let's travel there now. Our next guest says that the insatiable demand for equities has created huge supply in the local bond market. So is it actually time to buy the bond yield dip? Angus Coote joins us now via Skype. He's from Jamieson Coote Bonds to discuss. Welcome. Yeah, so give us a state of play in your eyes when it comes to fixed income here in Australia. Are we talking, sovereigns? Are we talking corporate?
Thanks very much for having me. Just before I start, the numbers in Melbourne are 11 today, so very encouraging news there. Look, Jamieson Coote Bonds is a sovereign-only bond manager, so I'm speaking specifically about government bonds, not corporate bonds. And the thing to like about government bonds in this market is liquidity, diversification away from that riskier corporate credit space and equity space. You get this counterbalance to your portfolios through those times of stress. We saw that in that March quarter, and you're getting government risk. And at the moment, we're seeing this tremendous amount of issuance from the AOFM, the Australian Debt Management Office, into the market at cheap prices. And as active bond managers, we can pick that up and actively transition that into our portfolio and make sizable gains for our investors, which we really like. We saw QE1, 2, and 3 firsthand. It's QE1 here in Australia when you're seeing the RBA at the front end buying those bonds. So it's very complementary for us in that government bond space. So if you look at the underlying yield, it doesn't look all that exciting at around 1%. But the bond market characteristics, and it's probably too much for this call here to explain, doesn't equate to the actual return. So returns for the index this year are just around 5%, just under. And so you need to look past that underlying yield and the benefits that are associated with investing in high-grade government bonds.
Angus, you mentioned the ramp up in new supply. We're going to see a record issuance from the AOFM this year. Do you expect that the market will be able to absorb all this new supply and keep, let's say, the 10-year below that 100 basis point level?
Yeah, absolutely. Look, Australia is a standout, AAA rated country. I think there's one of only 8 globally, maybe 7 now. I think Canada might have got a downgrade recently. And we've had a very small bond market for such a long period of time. And if you look comparatively, our 10-year at just under 1% versus some of the issuance that's going away in Europe, we look tremendously popular. And look, we're seeing that play out in the bond issues that the AOFM are doing. 10-year bond done late last month, $66 billion of demand for a $21 billion issue. That's any equity parlance, that would be a fantastic issuance. So no problems there with issuance. I mean, we're going to see from the budget in the next week or two what size a deficit we're going to have. But there's no issue with regards to issuing bonds in the market, and I don't believe that will be the case for a very long time. So as active managers, JCB are very excited by this prospect. So it's good for the market. It's good for the corporate bond market. A bigger government bond market means you can price more corporate debt. So it's really a good thing for the Australian capital markets, really, more than anything else.
That's a lovely little segue into my next question too. When it comes to the corporate credit space, now we're seeing record issuance there, particularly in the United States. Here locally, we haven't seen the same level of ramp up, but what are you looking for? Where are the pockets of value that still exist in credit?
Yeah, look, it's credit markets, again, look, not my specialty. I'm very much in the higher end space. But what I will say about the credit globally is that given we've seen this tremendous amount of stimulus from central banks on the fiscal side, we're seeing a huge amount of corporates. You hear the term zombie corporate going around. It's so much so that now 20% of all corporates in the United States are zombies in some form or another, and that means that their revenue can't service, cannot pay their debt back that they've incorporated over the previous years. So very much something to keep your eye on over the next few years, because we could see, particularly with some of the debts that need to be paid back, being problematic for some of these corporates. So look, I think that if you're going to be looking towards the corporate space, you have to go to high quality names.
Angus, I'm curious, where do you see the real risks lying for sovereign bond markets, for the markets that you're traveling and operating in? Because, of course, we've got plenty of risks out there when it comes to Brexit and the EU, when it comes to the US presidential election. Some people talking about the resurgence of inflation. I mean, what is sort of primarily on your radar?
Yeah, look, inflation's obviously the one that fixed income investors worry about the most. Our view is at JCB that we think we're going into a deflationary environment, and that the effects of M2 money supply increase that we've seen recently are transitory. Huge amounts of corporate hoarding and bringing down, lines of bank credit, and so therefore having to park that into the banking system. So therefore, it looks like it's an increase in money supply. And sure, we have seen an increase in quantitative easing, but if you look back at over QE1, 2, and 3, that was actually deflationary. And you saw the Fed governor come out in his June press conference and say, even after QE1, 2, and 3, and 128 quarters, we didn't actually achieve our inflation target. So we think that, for the next few years at least, it's going to be a deflationary environment. We've got massive debt overhangs. We've got aging demographics, technology, non-unionization. And so I think that, the real risk and it terrifies central banks is that you go into this deflationary type environment because it's very hard to get away. And we saw with Jackson Hole in late August, them changing their parameters around inflation targeting. And I think that's to try and counterbalance some of the inflationary trends that are out there.
So don't go chasing tips at the current levels, it sounds like. Angus, let's go and talk US election. Now, we're seeing the polls tighten up. I think everyone knows that we're going to go and look at a pretty close outcome here one way or another. How are you expecting markets, the fixed income world, to go and trade in the lead up and after the potential election result?
Yeah, it's a great question and a difficult one, other than to say, look, I think that volatility will pick up. Look, the betting markets, I was looking at this morning, which I think is a more reliable guide given what we've seen both domestically and offshore elections recently. It's incredible. We've got a market now where Biden is at $1.80 and Trump at $2. It's super tight. I think what will really matter is the composition of the House and the Senate after the election. We certainly saw this after the 2016 election where Trump got that clean sweep. Because if the Democrats get the clean sweep, then you're going to have people like Bernie Sanders and Elizabeth Warren talking about increasing taxes, et cetera, and taxing tech. Whereas if it's the Republicans that can get a clean sweep, then you're going to get this more turbocharged growth type outcome. So I think as we get into that election phase and closer to that time, you're going to see a bit more volatility play out. And I imagine around the actual date will be tremendously exciting for markets.
Okay, so lots still to come, but deflation, the real risk. All right, we really appreciate your time, Angus. Thanks for joining us today.
Thanks very much for having me on again.